Good morning, Peter. Thank you very much for doing this again. This time we get to talk about the fund properly. So without further ado, I'm going to let you just describe a bit about what CT's Global Managed Portfolio Trust does, please.
Okay, James, well, good morning, everybody. CT Managed Portfolio Trust, yes, it's a fund of investment trusts. It you should think of it as a long-term savings vehicle, almost exclusively for private individuals. We've got no other shareholders, private wealth managers, institutions. It's just individuals. And we've got two portfolios, one of which is a growth portfolio, and the other one is an income portfolio, but really think of it as a total return portfolio. And actually, they are quite separate, but within the one company, except for one thing. And I'm going to very briefly dwell on the bottom 3 points you see there. Transfer of income between the portfolios, which is a unique feature, which I'll come on to in a moment. We have a conversion facility. You can switch between the two portfolios at a pretty low cost level. It's the trust picks up most of the costs, and we keep a very tight control of the discounts. So we go over to the next page. This is the income transfer, and I apologize if it looks a little bit difficult, but actually it's not really as difficult as this may appear. If you can imagine the two pools, the income pool and the growth pool, worth 100 at the beginning of a year, and let's imagine there is no change in share prices over the year, which I know is ridiculous, but nonetheless, just for the basis of this example, the income pool, really since day one through to today, yields somewhere around about 4.5%. And the growth pool, focused mainly on capital growth investment trusts, yields round about 1.5%. And when the dividends, let's just say a Scottish mortgage dividend, that's a holding, so trust everyone knows, when that comes into the growth pool, it's then put on a conveyor belt and shifted across to the income pool. And over the course of a year, you have just over 1%, because that's the dividend yield, which is effectively transferred from growth to income. But at the same time, the same amount is transferred back from the income pool to the growth pool, except it's called capital. And so what is the result of this? Well, the result of this is that the growth pool does not pay a dividend, never has done, never will do. But at the end of this year, its NAV has been boosted actually by 1%. So it's got an NAV of 101. The income pool, on the other hand, sees its dividend yield of actually about 4.5, roughly, is its natural yield, is boosted over 5, somewhere between 5 and 6, courtesy of the extra income it's receiving. However, it also gives up about 1% or 1.5% of its NAV at the end of the year. So very briefly, that has been massively beneficial for the income pool. It has also been beneficial for the growth pool to some extent. It customizes returns, but it's meant with the income pool, I've never really been short of income. I've never had to go up the income spectrum to some quite high yielding trusts. So that's the income transfer. Hopefully it has no adverse tax implications either for the shareholders or within the trust itself, because all HMRC sees is the box on the right, because it's all in one company. And if you go on to the next page, once a year in October, actually, we have a conversion facility. You can switch between growth and income or income and growth. Under the current law, it's not treated as a disposal for capital gains purposes. We keep costs to an absolute minimum. The trust actually picks up most of them, and it's done at asset value. And because we keep both share prices pretty close to asset value, it's a good way if you want to transfer. And sometimes people, as they perhaps have been in the trust for 10 or 20 years, in the growth pool, they find a requirement for income. Well, here's a good way of doing this switch quite cheaply. And then the next page, couple of pages, just shows you what the history of the discount's been really since launch. That's the income portfolio. It trades at a very small premium and has done for, quite some considerable time. And we keep both income and growth. The growth actually is at a small discount at the moment, 2 or 3%, by a very active share buyback program and or share issuance program. So these are these three features: the income transfer, conversion facility, and how we don't want a double discount appearing here with our two shares. So we keep both share prices tight to NAV. Right, so let's move on, and that's just a summary, really, of the trust at the moment. It started in 2008 with 40 odd million of assets, and now it's actually pushing 170 million of assets, and it's got over 16,000 shareholders. So actually, that's a huge amount, and it shows there's lots of very small shareholders indeed. Average shareholding size is between 10 and 12,000 pounds. So this is really a trust for individuals. Let's keep moving on and keep the pace up. I just want to put in context what's been happening with investment trusts. I'm sure most of the listeners are aware, but this is a simple chart of the investment company subsector within the all-share index relative to the all-share index. And the way to read this is, if the line is rising, then investment companies are outperforming. And you can see there this is a chart of 10 years, but you could go back longer. Investment companies do tend to gently outperform. And then we had this period in round about lockdown, actually, where investment companies really performed incredibly well. And we got to late 2021, and what happened then was interest rates started going up to combat inflation, which itself was beginning to rise and rise sharply. And that had a very negative effect on the investment company sector. And you can see it gave up almost all of that outperformance that it had in 2020, 21, in the space of just a couple of years. More recently, in the last few months, there are some encouraging signs that investment company subsector is beginning to outperform. If we go on to the next page, sorry, that's just a page my compliance insisted I put in as what is an investment company discount. Let's move on beyond that. And this is a good chart and just explains really one of the key driving factors to the underperformance in 2022 and 2023. And if you can see there, the chart on the left, that's a chart of the average sector discount, which for long enough was round about 5, 4, and it even got to 2% in 2020. And very briefly, in the summer of 2021, it was at par. But then, as I said, interest rates started going up just before Christmas in 2021. And look what it did to discounts. Discounts widened out really quite sharply. And the average sector discount by last November got to 19. And so that tells you the share prices underperformed the asset values massively. And therefore, we didn't do well. Investment companies did not do well. Chart on the right shows you really the past year or so, and you can see how we got to 19% there in November. But things have begun to tighten in a bit more recently. And actually, as we speak today, the average sector discount is just over 12%. So that's helpful, and it shows that things are beginning to stir in the investment company sector. So that puts in context what I invest in. If you go on to the next page, I just thought I'd take one page on the income portfolio just to put in perspective what the dividend yield is. And the dividend yield on the all-share index as of today is 3.6%. On the all stocks index, for government bonds is 4.25%. And for the managed portfolio trust income portfolio is 6.15%. So that's quite a high yield. But if you look at the dividend growth, and in the last year we grew dividend by about 3%, we've actually achieved dividend growth over the last, I think it's 11 years. We're now an AIC next generation dividend hero. So you do get quite a big dividend here. And I'm not going to predict or forecast dividends, but all I'll say is the revenue account is in a very healthy place. So hopefully we're going to seek to continue that. Now, the next page does show you the performance. And you can see there the 5-year numbers in particular, even to some extent the 10-year numbers, were affected by really the very difficult period of 2022-2023 when investment companies underperformed the all-share index very significantly. But have a look at the 1-year numbers. They've actually turned quite sharply for the growth portfolio. It's now outperforming the all-share index. It had a very strong July, and so that's been extended. The income portfolio was still lagging, courtesy, as I think Andrew hinted at in his talk, the alternatives sector, which really had underperformed substantially and discounts had widened a lot. The income portfolio had had one of its best ever months in July, so that's in the process of turning as well. The longer term numbers, which have been affected by what went on so significantly in 2022 and 23, are still just about okay since launch. And if you go on to the next page, I'm not going to dwell on this too long. I have to put this in for compliance reasons. That's each individual year. And all I'll say is the growth portfolio outperformed for 9 consecutive years up till 2022. And then the wheels came off the wagon, as it did for investment company sector generally. The income portfolio actually has been much more steady, but it too has had a difficult time in the last couple of years. But actually, if you looked at the since inception numbers right now, they're both ahead of the all-share index. So moving on now to the themes and it's quite a busy slide, and I do want to spend just a moment explaining to the audience. My key investment theme, and again, Andrew touched on it a little bit when he was talking, is UK equity trusts. And I think they are looking really attractive just now. The stock market's been out of favor for years. Valuations are low. The profits outlook is okay and beginning to improve for later this year. And a lot of trusts in this area have been actually at quite wide discounts, albeit in the last few weeks, that's been beginning to tighten. So I've got some examples there. I've got big holdings in Fidelity Special Values, Law Debenture, Aurora, and Aberforth. They're all in the top 10 of the growth portfolio, and they've all been performing quite strongly. Henderson Smaller Companies, up 15% in July. And then in the income portfolio, it also has quite a lot of exposure to UK equity trusts. Mercantile is the 3rd biggest holding, Temple Bar. And then the JP Morgan UK Smaller Companies Fund has really also performed strongly, and it too is up 15% in July. So that's capitalizing on what I've been trying to outline there is a very cheap market. I think the narrative for the UK market has flipped. And I don't think politics often has much of an impact on markets, but suddenly we've gone from a period of really a lot of instability economically and politically to, whether you like it or not, there's now political stability, a focus from the government on growth, and actually the growth numbers are beginning to come through. We've just had an interest rate cut, which is massively positive for particularly trusts in the mid and small cap arena. So I think UK equity trusts could have a period of quite significant performance, having had a period of horrible performance really since the Brexit referendum back in 2016. I've got a decent exposure to private equity trusts. I think the discount's still wide. I visited Pantheon the other day. That discount is somewhere round in the mid-30s. And yet asset values, and Pantheon's a case in point, they produced their annual results. The NAV was up 6% and will probably be stronger than that in the current financial year. My biggest holding is HG Capital, which specializes in software companies. And this is a very unloved sector. And I think if we do get some result in the cost disclosure issue, which you might want to touch on later, this is a sector that will benefit hugely. The long-term records of some of these trusts is absolutely outstanding, and actually I think should form a part of everybody's portfolio. How else do you get exposed to high-growth private companies? So I think that's an interesting area, and I've got some holdings in the income portfolio too in private equity. And then finally, trusts with secular growth characteristics, mainly focusing on technology, healthcare, and the likes. And actually, they sold off sharply in July. And Allianz Technology, Polar Cap, and Scottish Mortgage all were down by quite a number of points, as there was a sell-off in the US tech sector. But be under no illusion. It's from trusts in this area that you will make many times your original investment. And so my only message here is stick with them. I'm going to, because I think I want to have exposure to growth, particularly for the growth portfolio. And so whether it's Scottish Mortgage, Worldwide Healthcare, Polar Cap Technology, they've all done really well in the long run. And I think they should form a core of the portfolio. Right, so if we can just move on quickly here. Here's the top 10 of the growth portfolio, and I tried to reflect some of what I've been saying there. So you can see there, I think, are 4 UK funds, and they've all got there through performance. It's not that I've been buying more of them. You can see the technology funds there, Polar Cap and Allianz Technology, and also private equity. And I've got one, Oakley Capital, is the 11th biggest holding. So that is, I'm quite comfortable with that top 10 just now. And if you go on to the next page, you will see what I've been buying or adding to in, really this is in the calendar year. So I've added some more to Aberforth. I bought a position in the JP Morgan UK small cap growth and income portfolio following the merger of the small cap trust and the mid cap trust that JP Morgan undertook. I added some Allianz and Polar Cap Technology at the turn of the year and bought quite a big position in Pantheon International as well, and also added some Scottish Mortgage, which is really, it's a big trust, Scottish Mortgage, but I think now it's definitely on the front foot and got some very interesting private equity holdings, which reviewed negatively for 2 or 3 years. But I think some of these ones, SpaceX in particular, is looking quite interesting. And then they were funded by some sales that I undertook, and you can see there, sold out of Hypnosis following the bid. And I've sold down some of the more defensive holdings like Capital Gearing, Personal Assets, sold out of Ruffer completely, because I'm now much more positive for the outlook, not just for the economy, but more especially for the stock market, and try to reflect that in some of the themes I've outlined for you. And then for the income portfolio, here's the top 10. You actually might notice Law Debenture appears in both portfolios, as does the JP Morgan UK Small Cap Trust, because they've got very good yields, both of them. But broadly speaking, I've tried to reflect the same themes. So UK equity there with Law Debenture, Mercantile's performed very strongly, as has Merchants Trust. City of London is there too, great dividend stock. And we've also got private equity holding with NB Private Equity. It's harder to get some of the technology trusts in there because they just don't yield. I've got one International Biotechnology, which is in the top 20, but I'm afraid it's difficult to get its secular growth holdings in there. And in the next page or two, you'll see what I've been buying and selling. And so there you are. TR Property is one I actually really am quite optimistic on. And I think what we had yesterday from the Bank of England is very helpful for the property sector. That is a well-managed trust. It's got a fantastic dividend record. It yields somewhere around about 4.5% and is a great way to play listed property companies. The manager, Marcus Fairmudge, he really knows the sector, is very experienced there. So that's what I've been doing on the purchase side. And on the sales side, you can see we came out of hypnosis. And actually, I like all these other three holdings, but I've just gently top sliced them because they've done quite well over the period. And so I think the next slide is probably the final slide, James. And it's really just what are the prospects for the next 18 months or so. And my point here is just to say that valuations in most equity markets are quite high and above long-term averages. And you can see the UK, the US forward, that's the next 12 months price earnings ratio at 21 times, possibly 20 times now, given the recent sell-off, is well above its long-term average of about 16. There is only one market, major market, that is well below its long-term average, and that's the UK equity market. So let's try and make the most of that. And as you can see there, just to reiterate my themes, I've increased exposure to UK equity investment companies, and that's coming through now with quite strong performance. And it must be between 40 and 50% in both portfolios. But I've held on to my holdings in secular growth trusts and also have raised earlier in the year exposure to private equity trusts. We were on very wide discounts indeed. James, that's a quick skate through the managed portfolio trust. But if you have any questions, then I'll do my best to answer.
We definitely do have some questions. Thank you very much for that. That's really helpful. So let's go back to just a couple of questions on the structure first. So given what's going on with the income here, how important is it that you actually cover the dividend with the revenue generated? Is that something that you're trying to do?
Well, the answer is yes. And we have a revenue reserve of roughly 3/4 of 1 year's dividend. So that should provide a lot of comfort as to the dividend outlook. But it's helpful getting that extra 1% from the growth pool. And it's helped us cover our dividends. And so that's one of the reasons why you're actually getting such a high dividend yield of 6% or so. So I think I'm comfortable on the revenue outlook. We're covering dividends. I think with a bit of luck, will probably cover them again in the current year, but it's early. We're a May year end, so I don't want to give out any forecasts. But the revenue the revenue account is quite healthy, and the underlying dividend increases from investment companies tend to be in the 3, 4, 5% region, which is reasonable. So I'm quite happy in that area, James.
Okay, good. Thank you. I suppose that there's a sort of big picture question here. Is it how do you actually decide what makes a good investment?
Well, now that's a $64,000 question. And the answer is it's not easy. I do spend quite a bit of time actually meeting the managers of trusts that I've got holdings in or might potentially have holdings in. And actually, it's only with sitting down with them maybe for an hour or so that often you can get to the real bones of what their investment process is, their investment strategy, what style they employ, and also you look for experienced managers who've perhaps been around the block a couple of times in terms of different market conditions. You can also, yes, do a bit of work with analysts or indeed the annual report, which I do actually read most of them. And actually what you can find out there is, well, what's the level of gearing? How is debt structured? because often gearing can make quite a difference to returns, particularly in the alternative sector. We've got examples there. Hypnosis, which I did own, and I quite liked elements of what they were doing, but too much debt really undid a lot of the good work that had initially happened with hypnosis. And so you've got to be on top of what's going on with balance sheets and levels of gearing and levels of debt and how that's structured. But you can also look at costs, fees, performance fees, how are costs allocated, all these sorts of things. You can build up a picture of trusts. And I try and dovetail it with a macro view. In this case, you can see I've been quite optimistic about the UK. And so, you know, how can we try and capitalize on that? And you've got a series of really good managers with trusts there. But if you looked at the record, you would see most of them have been underperforming for the last year, 3 years. And you would say, well, why should I bother? But actually, that's when you can really dig underneath and try and find out what's been happening with leadership in the market and investments within the market. And actually, you decide, well, if I'm going to be a bit more optimistic about the UK, I think the following trusts will do quite well in a different environment. And that's what you see there. So
Trying to get that message across. Just don't buy what's been going up. Go and actually look for things that are cheap. That's the hardest thing, I think. That's just most of my job. There we are. Now, obviously, because you're buying trusts, and you mentioned cost disclosure before, can we just sort of talk through what your ongoing charges ratio is, whether you think that affects whether people invest in the fund or not, and what you think the right approach to cost disclosure ought to be, please?
well, our ongoing charges are just over 1%. For both portfolios, and they've come down very slightly over the last few years as they've got a little bit bigger. But then if you look at the underlying costs in the KID document, they appear a lot higher. And if I said something like 2.5% of that order, and that's actually boosted a lot by me investing in private equity trusts, which superficially are very high cost vehicles. Now, there's some reasons for that. They have to employ more people. It's a different type of investment than investing just in listed FTSE 100 companies. I mean, I think private equity trust fees are generally too high. But I do my best to try and kind of see the wood from the trees, because despite, in inverted commas, these very high levels of costs, why is it that these trusts are amongst the best performers over the long term, miles ahead of the all-share index? I mean, Pantheon is a case in point. I think it listed in 1987, and its NAV is compounded at somewhere between 12 and 13% per annum, whereas the all-share index, I think it's somewhere between 6 and 7. That's with these apparently outrageous costs.
Yeah.
So, you know, I think we just have to just keep an eye on what the final output is and the final share price return. Now, I hope there is movement on cost disclosure, James, because I think it's embraced within share prices. And if there is a discount, then that often could be due to higher levels of cost, amongst other things. But it makes investment companies appear to be a lot more expensive than they actually genuinely are. And therefore, I think it puts off, certainly in the private wealth audience. And I understand that. But I think hopefully if we get some resolution regarding cost disclosures, that could be good news for particularly the alternative sector within investment companies.
Yeah, I agree. Thank you. Now then, HG, you mentioned, obviously your biggest holding here. What is it you think about that trust that's made it so successful?
Well, HG Capital is it's a private equity trust. It focuses on predominantly software companies in the business to business sector across Europe. And that's lots of different areas too: payroll, accounting, HR, whole variety of different sectors, a very fragmented area. But typically, companies in the HG hold have quite predictable revenues. The clients they deal with will tend to be on a 1-year rolling basis, for example. So HG and the companies they own know well in advance what their revenues are going to be. They're growing because they're particularly addressing small and mid-cap companies who are who require, sort of more, how can I put this, in the field of digital transformation, payroll, accounting, more prosaic areas. That's a huge cost saving for underlying companies. And so they contract with some of the HG's holdings, and presto, you've got some very interesting businesses across Europe. And actually, HG Capital, I think they were saying that if it was the underlying companies were listed, they'd be the second biggest software company in Europe, which is amazing.
Yeah,
So
totally.
it's had a really rapid NAV growth, and I think the long-term future is still very good there. Now, it's got it's the best rated of the private equity trusts, and it's not far off asset values as we speak. But it's one you want to have for the longer term. So that's why I like it. And I bought it in I think 2015, and it's made about 4 times the money since then, which is not bad going.
No, exactly. So in the income portfolio, you've got 3i infrastructure in there. Have you got much else within the kind of renewables and infrastructure sectors?
I've got a bit, James, and they were amongst the worst performers in the last year, albeit the dividends came through fine. But Greencoat UK Wind is just outside the top 10. I've got the Renewables Infrastructure Group, which is further down the portfolio, and they both have been selling at quite wide discounts. I've got 3i Infrastructure, which has done quite well, and I've got 1 or 2 other alternatives, like, for example, Impact Healthcare, which again has been yielding close to 8%, and the dividend has been growing, but the share price has underperformed substantially. It's now at a discount of well over 20% to NAV. So in the past year, 18 months, has not been helpful for performance, for the capital performance of the income portfolio. But in all cases, the dividends have come through really well. And in the long run, you see 3i Infrastructure there. I mean, that is one of the best performing stocks in that portfolio, has been 3i Infrastructure, which I've had for 10, 12 years. And it's been the capital growth from that has been outstanding, along with a dividend that's compounds at 6, 7% per annum. I think it's ideal for an income portfolio. Now, going forward, it's not clear with renewables yet. I haven't formed my view. I like the income that we're getting, but they are very out of favor. And I think the one thing that has perhaps disappointed not just me, but investors generally, has been the asset value performance is not really linked to what's going on with the FTSE 100 or the S&P. It's to do with other issues like power prices and revenue and things like that. But the share prices have been very sensitive to bond yields and interest rates. And I don't think any of us really appreciated quite how sensitive until recently. So now, with interest rates coming down and possibly bond yields also coming off a bit. Actually, I've just been finishing writing my fact sheet for July. One of the better performers in the income portfolio was Greencoat UK Wind. Shares were up 10%. So be interesting from here what happens.
Yeah, definitely. And you mentioned Impact Healthcare REIT there. So what do you think about property sector? You mentioned Care Property too. Do you think that's
Yes.
something you'd like to have more of now, or
Well, yes, I actually Impact is about the only I used to have quite a number of specialty property companies. I remember Supermarket Income REIT, Assura, and others, LXI REIT, which actually got acquired. Although I own Secure Income, which LXI first acquired. But I kind of, in the short and medium term anyway, I've decided, yes, I quite like the property sector, but I want to play that through TR property. And if anything, I would own more, not less of that one. I think it's well managed and it should be performing, and is. It was one of the best performers in July, James. But whether that continues or not, I'm not sure. But I do think that's the way I want to play property at the moment.
Great. I think we covered an awful lot of ground, and hopefully people learned a lot about the fund. So we'll get you back again another time, but thank you very much for your time today. And good luck with it all. I do like the whole approach, as you know. So there we go. There's the disclaimer. We must put that up. And then we'll be back next week talking to Matt Cable from Rights and Issues. Now that Dan's gone, he's the sole manager there, so it'll be interesting to see what he's got to say. And sticking with the UK, we'll have Ian Lance from Temple Bar the week after. And then we've got a full lineup all the way through. And our new panel show, Peter was on the last one, but the new panel show for September is going to be talking about the new government and what impacts that's having in the UK. So thank you very much for tuning in today, and we will see you next Friday. Have a good weekend. Thanks. Bye-bye.